Guys, welcome back to our channel Business Ideas. In this video, we'll be talking about mortgage rates and how to make money with them. Before we begin though, be sure to subscribe to the channel so that you never miss out on our latest uploads. Now, without further ado, let's get right into today's video. A mortgage rate is the rate of interest charged on a mortgage. Mortgage rates are determined by the lender and can be either fixed, staying the same for the term of the mortgage, or variable, fluctuating with a benchmark interest rate. Mortgage rates vary for borrowers based on their credit profile. Mortgage rate averages also rise and fall with interest rate cycles and can drastically affect the home buyers' market. The mortgage rate is a primary consideration for home buyers looking to finance a new home purchase with a mortgage loan. Other factors are also involved, which include collateral, principal, interest, taxes, and insurance. The collateral on a mortgage is the house itself, and the principal is the initial amount for the loan. Taxes and insurance vary according to the location of the home and are usually an estimated figure until the time of purchase. Mortgage rate indicators. There are a few indicators potential home buyers can follow when considering a mortgage loan. The prime rate is one indicator. This rate represents the lowest average rate banks are offering for credit. Banks use the prime rate for interbank lending and may also offer prime rates to the highest credit quality borrowers. The prime rate typically follows trends in the Federal Reserve's federal funds rate and is usually approximately 3% higher than the current federal funds rate. Another indicator for borrowers is the 10-year Treasury bond yield. This yield helps to show market trends as well. If the bond yield rises, mortgage rates typically rise as well. The inverse is the same. If the bond yield drops, mortgage rates will usually also drop. Even though most mortgages are calculated based on a 30-year time frame, after 10 years, many mortgages are either paid off or refinanced for a new rate. Therefore, the 10-year Treasury bond yield can be an excellent standard to judge. You can use Investopedia's mortgage calculator to estimate monthly mortgage payments. How does mortgage interest work? Buying a home with a mortgage is the largest financial transaction most of us will make. Typically, a bank or a mortgage lender will finance 80% of the price of the home and you agree to pay it back with interest over a specific period. As you compare lenders, mortgage rates and loan options, it's helpful to understand how mortgages work and which kind may be the best for you. How mortgage payments are calculated. With most mortgages, you pay back a portion of the amount you borrowed, the principal plus interest every month. Your lender will use an amortization formula to create a payment schedule that breaks down each payment into principal and interest. If you make payments according to the loan's amortization schedule, the loan will be fully paid off by the end of its set term, such as 30 years. If the mortgage is a fixed-rate loan, each payment will be an equal dollar amount. If the mortgage is an adjustable rate loan, the payment will change periodically as the interest rate on the loan changes. The term or length of your loan also determines how much you'll pay each month. The longer the term, the lower your monthly payments will typically be. The trade-off is that the longer you take to pay off your mortgage, the higher the overall purchase cost for your home will be because you'll be paying interest for a longer period. Fixed rate versus adjustable rate mortgages. Banks and lenders primarily offer two basic types of loans. Fixed rate, the interest rate does not change, or adjustable rate, the interest rate will change after defined conditions, also called a variable rate or a hybrid loan. Here's how the two types work. Fixed rate mortgages. With this type of mortgage, the interest rate is locked in for the life of the loan and does not change. The monthly payment also remains the same for the life of the loan. Loans often have a repayment lifespan of 30 years, although shorter lengths of 10, 15, or 20 years are also widely available. Shorter loans require larger monthly payments but lower total interest costs. Adjustable rate mortgages (ARMs). Because the interest rate on an adjustable rate mortgage is not permanently locked in, the monthly payment will change over the life of the loan. Most ARMs have limits or caps on how much the interest rate can fluctuate, how often it can be changed, and how high it can go. When the rate goes up or down, the lender recalculates your monthly payment, which will then remain stable until the next adjustment occurs. As with a fixed-rate mortgage, when the lender receives your monthly payment, it will apply a portion to interest and another portion to the principal. Lenders often offer lower interest rates for the first few years of an ARM, which are sometimes called teaser rates, but these can change after that, as often as once a year. The initial interest rate for an ARM tends to be significantly lower than that of a fixed-rate mortgage. For that reason, ARMs can be attractive if you're planning to stay in your home for only a few years. If you're considering an ARM, find out how its interest rate is determined. Many are tied to a certain index, such as the rate on one-year US Treasury bills, plus a certain additional percentage on margin. Also, ask how often the interest rate will adjust. For example, a 5 to 1 year ARM has a fixed rate for 5 years. After that, the interest rate will adjust each year for the remainder of the loan period. How do mortgage lenders make money? Mortgage lenders can make money in a variety of ways, including origination fees, yield spread premiums, discount points, closing costs, mortgage-backed securities (MBS), and loan servicing. Origination fees. Because lenders use their funds when extending mortgages, they typically charge an origination fee of 0.5 to 1% of the loan value, which is due with mortgage payments. This fee increases the overall interest rate paid, also known as the annual percentage rate (APR) on a mortgage, and the total cost of the home. The APR is the mortgage interest rate plus other charges. Yield spread premium. Mortgage lenders use funds from their depositors or borrow money from larger banks at lower interest rates to extend loans. The difference between the interest rate and the lender charges homeowners for extending a mortgage and the rate the lender pays for replacing the money borrowed is the yield spread premium (YSP). For example, the lender borrows funds at 4% interest and extends a mortgage at 6% interest, earning 2% in interest on the loan. Discount points. Part of the loan, known as a discount point, may be due at closing to help buy down the mortgage interest rate. One discount point equals 1% of the mortgage amount and may reduce the amount of the loan by 0.125 to 0.25%. For example, 2 points on a $200,000 mortgage are 2% of the loan amount, or $4,000. Closing costs. In addition to the loan origination fee, an application fee, processing fee, underwriting fee, loan lock fee, and other fees charged by lenders are paid during closing. Because these closing costs may vary by lender, the fees are explained up front in the Good Faith Estimate (GFE). Mortgage-backed securities. After closing on different types of mortgages, lenders will group loans of varying profit levels into mortgage-backed securities and sell them for a profit. This frees up money for the lenders to extend additional mortgages and earn more income. Pension funds, insurance companies, and other institutional investors purchase the MBS for long-term income. Well guys, that's all we have for you for today. What are your thoughts on this? Get involved and let us know in the comment section down below what you think about today's video. If you liked the video and found it informative, then be sure to give this video a big thumbs up. Also, if you don't want to miss out on any new future videos like this, then be sure to click the subscribe button and turn on the notification under this video so that you're notified the next time we upload a new video. Thanks for watching guys, we hope you have a great day today, and we'll see you in the next video.